So Marc Ganzi, Marc was doing telecom infrastructure before telecom infrastructure was cool. And his background goes back 20 years. He is the managing partner at Digital Colony. He is moving through Digital Bridge with a very exciting portfolio in the space, in the digital infrastructure space of Data Bank, Vantage, Extenet, Vertical Bridge, Mexico Tower Partners, almost a personification of the vertical integration in the space. And as many of you know, prior to Digital Bridge, he was the founder and CEO of Global Tower Partners. Dan Caruso equally needs no introduction. Dan has been a keynoter here for 10 years. I've run out of innovative ways to introduce Dan, but I've known Dan actually for 30 years since he left Ameritech to come to MFS, where I was as a senior VP law, and shook things up then. We even created a skunk works called MFS Development around him, and he's been shaking things up ever since. So it's with great pleasure that I introduce Marc, who in turn will pass the baton to Dan.
Thank you. Good morning. I'm going to try to do this as quickly as I can. There's a lot of content that I want to cover, and let Dan give his remarks, which I think are going to be very voluminous. Three things we want to try to do today. One is demystify, what we're doing at Digital Colony today, and give you a little insight into the playbook, the long-term playbook of Colony Capital as the first fully integrated digital REIT in the world, and want to share with you and peel back the onion a little bit and how we're thinking about that and the strategy behind it and how we serve customers and how we serve investors alike. Want to talk about digital infrastructure as a converged ecosystem, which is something we've been talking about for the last 3 years. We believe that's no longer a subject of conversation. We think it's now a subject of execution. And I think some of the things that we're doing and eminently with Zayo really speak to that bullseye of where we think the market is moving. And then just give you some thoughts around my views around the challenges and the opportunities that sit in the digital ecosystem today. So I'm going to move quickly and briskly. Just quickly, Colony Capital, as most of you know, was historically a traditional real estate investment trust. The company made a bold announcement this summer that it was pivoting to digital. They acquired our management company, Digital Bridge Holdings, which Mr. Lippman walked you through some of the companies we own. We've begun the process of integrating those two businesses together, and what it looks like on the other side is, 28 years of great results for investors, 400 employees worldwide, 21 global locations, $49 billion of assets under management, of which roughly about 40% of those assets sit in digital infrastructure, and the rest sit in traditional real estate. Just so you know, Digital Colony is the investment management arm of Colony that only focuses on digital infrastructure. And that's where we see the future of the REIT. So thinking about our position and where we fit in this ecosystem today, what we've tried to do is we want you to think of us as one family. But as you look across the ecosystem and you think about the assets that we own and or manage, we have over 350,000 macro site locations, 135,000 route miles once we consummate the relationship with Zayo, 35,000 small cell nodes, predominantly in Latin America, UK, and the US. And then last but not least, once again, pro forma for Zayo, 95 data centers, which would make us the #3 data center operator in the world. From a fiber perspective, it would make us #2. From a tower perspective, we would sit at #4. And then last but not least, on the small cell side, we sit at #2. So in these individual swim lanes, we have market leadership positions. What I would offer to you is, holistically, as you think about the entire family, we are the largest owner-operator of digital infrastructure in the world. And that makes Colony Capital a very unique proposition. So as I said before, how do we do this inside of the Digital Colony sleeve? We've got 11 distinct investments today, 19 billion of assets under management. Believe it or not, over the last 6 years since we formed DigitalBridge, we've done 300 M&A deals. So a lot of small transactions ultimately accreting up to these larger platforms. And we're engaged across the entire mobile and internet infrastructure ecosystem. We believe there are no boundaries to the ecosystem. And so where we play and where our global reach is today, we're in Canada, we're in the US, we're all throughout Latin America, we're in Europe, and now we also have a strong presence in Asia, 3 offices and 12 people now sitting on the ground in Asia looking at digital infrastructure opportunities there. We don't get this done without a great team. I've had the distinct privilege, and many of my partners are in the room today, but 25 years of working with some of the best leaders in digital infrastructure, and the only way we've been able to do this is with great partners that are engaged and really understand their swim lanes and understand their customers and understand culture. And that's really if people ask us, what is the secret sauce in building value today? It's people. It's always been people. And that's where my career started, and I feel very privileged to have great partners. So our mission is pretty simple now. As a REIT, as a real estate investment trust, our goal is quite simple. We want to be the leading real estate solutions provider to some of the most trusted brands in the world. And as our chairman, Tom Barrack, says, we follow the logos. And that's something we've been doing at Digital Colony for 25 years, working with customers, helping them find great solutions, and most importantly, delivering, post-delivering the facility, then executing, and making sure that their network stays up and stays operational without any interruptions. You know, our ability to do that is rooted in the fact that we have access to permanent capital. And permanent capital is a really important part of the value proposition for customers today, knowing that we can invest in their infrastructure and that we're going to be there for the long haul, and they can go to bed at night knowing their network is safe, and that we have the ability on a moment's notice to deploy capital quickly and efficiently. This is a significant differentiated approach for us. So as we think about our peer group, and this is a really distinguished peer group, I'd be lucky to be in the conversation with any of these 5 logos, but we thought we would introduce the conversation with these 5 logos. And so as a diversified digital REIT, we also have an investment management business. So a lot like Brookfield and Macquarie, we have funds. We go out, we make investments, we back management teams, we back good ideas. On the balance sheet, we own assets, similar to Equinix, similar to Digital Realty, similar to American Tower. What's unique and differentiated about our approach is we are the only diversified global REIT that allows you to play across the entire ecosystem. Each one of these logos up here below Colony Capital are absolutely best in class. Some of them are operated by friends of mine, and I have massive respect for all of these companies. But at the end of the day, as we start looking towards converged networks, there's only one REIT that you can buy that allows you to have and participate across the ecosystem, and that is Colony Capital. So our framework is rooted heavily in 25 years of making mistakes. We have a very disciplined approach to alpha creation. And trust me, I'm looking at some of our CEOs in the room. We've made plenty of mistakes. What that allows us to do, though, is get the playbook right. And what we've learned over 25 years is, at first, as I said at the beginning, it starts with people. It then starts with having that direct operating experience where you have the trust of your customers, where you can deliver 5-9 standards. It's having the knowledge to take information and back office IT systems and to be able to digest that data, weaponize it, and then apply it to your customers and apply it to their business models and help them achieve their objectives. Information is power. The ability to reduce cycle time and the ability to help your customers enable a decision faster than your competitors is comparative advantage. We only achieve that through the weaponization of our IT systems. We have a very differentiated M&A approach. As I told you, we've done 300 M&A deals at Digital Colony. If you go down to our portfolio companies over the last 10 years, we've actually done over 1,700 M&A deals. And the way we do M&A is we do it through relationships. Many people in the room that I'm looking at now, I've done an M&A deal with. And we're a trusted source to transact with. We transact efficiently. We speak for the capital. And we don't pull any punches. Our word is our bond. Dynamic balance sheet management, having the ability to transform the balance sheet and achieve a lower cost of capital vis-a-vis our public peers is another comparative advantage. We've accessed the institutional bond market many times. We did it all the way back in 2004, securitizing cell towers. We did the first ever Latin America cell tower securitization at Mexico Tower Partners. We then turned around and did the first hyperscale data center securitization at Vantage. And then last year, completing the first ever of its kind a fully dedicated securitization of small cell infrastructure and fiber, the first of its kind, 100% dedicated to fiber and small cells. Last but not least is ESG. It is absolutely essential that we continue to leave good footprints in our community. We talk about this at the portfolio company level. We talk about it at Colony. We have a responsibility. That responsibility is to make sure the infrastructure that we build and we delivers a carbon-friendly footprint, and that we look back in time and say, those facilities that we built made a difference, but they did so without damaging the planet. And I look at everyone in the room to answer that challenge. From a governance perspective, we support diversity. At all of our boards, we're focused on making sure that our boards have diversity, transparency, and that investors understand exactly what we're doing and that we're committed to that process. And then last but not least, giving and making sure that you're in your community and that you're present. That's not something that we just picked up in the last year because investors told us that was important. That's something that we've been doing for over 2 decades. And I'm looking at some of our portfolio company CEOs, making a difference in your community, not just with a check. We talk a lot about you can't just write a vacant check. You've got to be present, you've got to be engaged, and that engagement has to be all the way through your workforce, starting at the C-suite, all the way to the bottom. Everyone chips in, everyone donates at least 2 days a year of their time at all of our portfolio companies. And so this is really the holistic approach to investing, right? The idea is that ultimately investors give us their capital. Ultimately, we perform for our customers, and we perform for our communities. And at the end, what it accretes to is, we believe, outsized returns. So let's talk about our sector and just some of the secular tailwinds that Mr. Lippman has discussed before. It's incredible. Every year that I get up and I give a speech, whether it's at Tower Exchange or Metro Connect, these metrics just keep going up. It's absolutely stunning what's happening. And it starts first and foremost with mobile connections, right? As we think about what's happening today across the mobile networks, we have 3.6 billion mobile internet users today. That's outstanding. If you think about the total population on the planet, we're barely scratching the surface. We're less than 50% penetrated globally in terms of mobile internet access today. Where do we think this goes? We think this goes to 5 billion over the next 5 years, which represents about a 5% CAGR growth rate. So a lot of growth still left in mobile internet penetration, which should give everyone in this room a significant amount of optimism. This is the metric we really think about. What are our customers doing? Where are they putting their CapEx to work? $482 billion of CapEx are going to be spent, has been spent in the last 2 years, and as we think about that trajectory through 2020, carriers continue to spend money. And if you think about where that CapEx shift is, look down below there, you see $160 billion of CapEx will be deployed this year. $123 billion will be in the US and Korea. The rest, $37 billion, will be rest of the world. So a lot of that, as we've talked about in the past, the US is a leading economy as it relates to infrastructure and as it relates to particularly mobile internet infrastructure. And you only see this accelerating in 2020. So there's a massive amount of opportunity for everybody in this room. We talk about the Internet of Things. And as we look backwards, there are about 9 billion IoT connections in 2018. That grows to 25.2 billion connections over the next 5 years. It's staggering. As we think about the real users of this network, it's not us. It's not the consumer. It's this notion of connected devices, a connected planet. And I offer to you that the biggest opportunity set for everyone in this room has little to do with the implication of consumer-to-consumer connections. And you need to start thinking bigger about where network topology is going. Smartphone penetration is still very much in its infancy. 43% penetration in 2018, going to 59% in 2025. And then 5G is literally at its infancy. If we look at the metrics around 5G, we have 1.4 billion users by 2025. And it only represents 15% of global connections. So 5G is going to be an incredibly long investment cycle to move consumers onto those devices. So what are some of the leading indicators that we need to think about in terms of where investment is coming? I think of 2 things. One, I think of cloud expansion, and I think of 5G shipments. These are great leading indicators for where the CapEx is going to be spent and where we're going. So as we think about in 2020, in terms of where cloud CapEx expenditures are going, and remember, cloud CapEx expenditures isn't just hyperscale data centers. It's all of the infrastructure associated with the ecosystem that goes into deploying cloud networks. So it's not just limited to how do I build a cloud data center. It's about bringing the bandwidth. it's about applications, it's about hardware, it's the entire ecosystem. So just think about, in terms of the CapEx spend, there's about a $37.5 billion CapEx spend in the world outside of China, and we've isolated China because the Chinese are investing heavily in two things right now, cloud computing and 5G, and they're outspending us pro rata. In China, they're going to spend $18.3 billion in CapEx related to continuing to grow their dominance in Asia around cloud. As we think about 5G phone shipments, once again, very, very small amount of 5G phone shipments this year in the US, accelerating to about 50 million in 2021, but the rest of the world is vastly surpassing the US in terms of 5G phone shipments. And when we talk about we're losing the war in terms of 5G supremacy or 5G deployments, the math and the arithmetic are embedded here in the shipments of the phones. This demonstrates to you that we are actually, for the first time, a laggard in 5G deployment vis-a-vis where you look at this in 4G and you could flip the script. We were a leader in 4G phone shipments, and now we're a laggard in 5G phone shipments. So there's a lot of work to do here. Fiber. Fiber is absolutely crucial to all of this. As we've said time and time again, Dan has said it, it's the connective tissue that binds all of this together. If you don't have the fiber connectivity, you cannot enable transformation in this digital realm. And so as we think about the evolution, and Dan's going to talk about the evolution of fiber and his journey at Zayo, but look at where fiber has gone. And if you think about where we were in the ultimate boom cycle, the supply boom was really 97 to 2001. As you look at how many fiber route miles were built, much of this by Caruso and Co. and friends, but look at the amount of actual fiber, the data usage, and the amount of fiber that was available. The reason a lot of the companies busted in the early 2000s is we had way too much fiber and not enough usage. Now what I would offer to you is we have certainly a lot of route miles coming online, but what we have is the total amount of data consumption exponentially growing faster than the amount of route miles that we're bringing on now. So this really offers a significant opportunity to the sector. Couple that with 5G, and what you see is a massive explosion, or what I call the data tsunami. And 5G really delivers the promise of a couple of things, I think. One, to consumers, and ultimately to B2B connections, and then M2M connections. First and foremost, we believe we increase capacity by almost 1,000 times. So think about it as a pipe. If this were the 4G pipe, think about the 5G pipe as being almost 1,000 times bigger in terms of the bandwidth capacity that you can push through that pipe. We're connecting 7 billion people, 7 trillion devices. Think about that number for a second, 7 trillion. We're talking about energy savings. By the way, getting back to ESG, we do believe that 5G offers the opportunity to consume less energy, and that's really embedded in two factors. One, the semiconductors that are in the phones and the batteries, but two, also the distance, right, the latency. The latency between the device and the antenna much shorter, consuming less energy, smaller devices that consume less energy, and we believe you create less of a carbon footprint as we think about how to deploy and build 5G networks. And then last but not least, the promise of zero latency. So in this next iteration of mobile topography and how we think about networks and where they're going, everything that we've seen to date, going all the way back to the 90s and the early 2000s, was very consumer-driven, very device-driven. This next step function is really no longer about the consumer. It's really about technology transformation and business transformation. And you see multiple industries being impacted by the ability to deliver higher speed data services and impacting business models. So no longer impacting the consumer. What I would offer to you is that this now impacts businesses, it impacts applications, and it impacts machine-to-machine learning. And the Internet of Everything, or the IoT networks, are the ability to deploy all of this infrastructure seamlessly. So we get increased bandwidth, more content control, higher security, privacy becomes very important, and most importantly, we talked about it earlier, that 5.9 standards, that reliability. This is really sort of where we see the vision for 5G going. All at the same time, massive, massive consumption of data. All happening behind the scenes seamlessly, where fiber is that connective tissue. So we believe, it's a theory that we put out there, I think about 2 years ago, that the build of 5G is the most complicated, the most difficult, and the most long-cycled build we've ever seen in the industry. And the reason for that is it's no longer just a consumer-facing opportunity. And so therefore, the dinner bill, as I like to say, for 5G is the most expensive dinner bill the carriers have ever seen. We go around the globe, and I talk to CEOs of the mobile operators, and they're terrified at 5G. And why wouldn't they be? The spectrum is very expensive, the equipment's expensive, and the business cases are not terribly compelling in a world where ARPU is getting compressed and there's more competition. And you've got disruptive brands in places like India, you've got disruption in Chile, you've got disruption in Europe, you have disruption here in the United States with the uncarrier carrier. So disruption is everywhere. Everyone wants to be the disruptive carrier, but also everyone wants to deploy 5G and deliver the promise of future networks. And there's a pinch. The pinch is CapEx. And so we think we can be part of that solution. And where you get to is ultimately, in a converged network, more neutral host networks is what I'd offer to the crowd. And I'd want you to go home and think about that. And so neutral host, from our perspective, is the opportunity to allow carriers to share infrastructure, something that Dan and Zayo has been talking about for over a decade. The only way we achieve the ultimate goal of 5G is by sharing infrastructure. And you see it already happening in Europe. The European carriers absolutely know the only way they survive is by sharing infrastructure. They're already doing it. And so the next iteration of this is, how do you think about network architecture? How do you begin to decentralize the RAN? And do you begin to trust neutral host providers to actually host the network, host the spectrum, deliver the bandwidth? And we're doing that, actually. At Freshwave Group in the UK, we're a partner for Vodafone, where they've given us their spectrum in certain parts of the country, and we are their neutral host provider. That model works. You go to Mexico, and I think Jose Sola is here in the crowd. You think about some of the initiatives that Altan is doing, where you've got Telefonica, you've got Total Play, and you've got AT&T all running and using the same infrastructure at the same time. So imagine this notion of converged networks and network sharing. We got to go south of the border to figure out where the new business models are. And where's the convergence of the RAN? The convergence of the RAN happens in a baseband hotel. Well, how do you deploy a baseband hotel efficiently across multiple tower sites and small cells? Really simple, fiber. And I'm not talking about 2 pairs, I'm not talking about 4 pans, I'm talking about massive fiber connectivity, straight to the node, straight to the remote radio unit, and all the while using a centralized location where that infrastructure and that cost of fiber and the towers and the small cells are shared. This, I believe, is the ultimate opportunity for everyone in this room. And most importantly, we get to begin talking about how do we save money for our customers. The only relevant conversation you're going to have with a customer is if you sit with them and explain to them how you are going to ultimately make their CapEx expenditures go down and make their OpEx go down. If you figure out that Rubik's Cube, carriers will meet with you all day long. If you come in and say, oh, I just want to build a new lateral for you, I want to build a new long-haul route for you, and you pay me this MMR and this NRC, yep, that's nice. Have a good day. You have to rethink the model. And that's what I would ask you to do today. And so as we think about this, here's a case study for you. And this is not science fiction, right? This is actually happening. So this is, by example, Pittsburgh, Pennsylvania. So this is Uber's pilot program with Carnegie Mellon. And so we actually have that infrastructure running on Extenet small cells. There's Zayo fiber in Pittsburgh. There's DataBank data centers where ultimately Uber and Carnegie Mellon's servers sit in our data center, powered by Zayo's fiber, powered by, where are my guys from Extenet? There they are. Powered by our nodes and small cells in the city of Pittsburgh. So think about that. The ability to deliver an autonomous driving experience in Pittsburgh is fueled by all of the infrastructure that we enable. And by the way, one company doesn't figure out how to deliver this. This is multiple companies coming together and delivering the promise of this network. And ultimately, as you see the ecosystem and you see the different touch points, you've got a shared baseband controller up on a utility pole, right, a small cell. You've got fiber going back ultimately to an edge data center or a CRAN hub where there's multiple aggregation points where you have this notion of the RAN, decentralized RAN. You've got massive fiber coming back to either a data center or a network operations center, which is the data center, where you have the artificial intelligence that fuels all of this at the same time. And then think about the different things that are happening in a car. Someone told me the other day, you can no longer measure what's happening in a car by terabytes. You have to think about a car as a consumer in exabytes. What is that? That's GPS, your satellite radio, your cameras, your radar, your LiDAR. I mean, there's all these things happening in a car, and you have nothing to do with it. Your cell phone has nothing to do with it. All of this is different sensors talking to nodes, communicated by fiber, going back to a data center, processing that information, reprocessing that information, and bringing it back to the car, and ultimately calibrating the decision-making in your car with you having nothing to do with it. That's not science fiction. That is happening today. All right, so that's my rah-rah part of the speech. Let's go to the reality. The reality sometimes is always less sexy than the fun science fiction part. So, digital infrastructure, it is utilitarian, it's complex. We believe and have conviction around this asset class. I wouldn't be sitting here today if it wasn't for this asset class and the fact that I didn't have conviction. That conviction is driven fundamentally in long-term growth characteristics. It's driven and embedded in the fact that our customers are going to continue to spend CapEx, and it's also embedded in the fact that we're going to continue to build infrastructure and supply that to our customers. It's a unique asset class. Why? And why do you see so much capital flowing into digital infrastructure? Well, it delivers capital appreciation. We've seen multiple expansion. We've seen the ability to drive more free cash flow through shared infrastructure. And then you have mega trends growing in data and mobile communications on a global basis that really afford the opportunity for investors to look at private market solutions and public market solutions at the same time. Massive amount of capital inflows going into digital infrastructure. But unlike other forms of communications, unlike other forms of traditional infrastructure, it has massive operating complexities. These are not toll roads. These are not airports, although airports have complexities. This isn't midstream pipelines. This is a business that requires a unique set of operating and technical capabilities that are resident in this room and at this conference. All at the same time, you have to wake up every day and know that your network has to be up 24/7. You've got to deliver that 5.9 standards to remain relevant in the industry. So that requires a stable set of hands. And that's why we rely on a great ecosystem of 16 CEOs that drive our different companies every day, and almost close to, today, globally, 12,000 employees that operate at our portfolio companies with one singular mission, which is to deliver for the customer. So I would offer that as much as this is a great opportunity, I would offer a cautionary tale at the same time, which is that this flood of private capital, all of the new entrants into the asset class, has driven valuation multiples up. The data doesn't lie, right? You see what's happening in towers, you see what's happening in fiber. Fiber today, on a private market basis, trades higher than towers. I never thought I'd see that day, Dan Caruso. So last year, private market multiples in 2018, 2 years ago, well, a year ago, traded at 18.6 globally. Fiber deals traded at 20.3. These are private market comps, right? And so what are the things that are in the back of our mind as we think about this opportunity? Because we think it's huge, we think it's enormous, we think it's a great opportunity, but at the same time, we see troubling signs. And this isn't pronounced globally, it's just there's certain markets where we see overbuilding, we see overcapacity, and we see platforms that are being backed by infrastructure investors that are simply lighting up capacity for the sake of just putting capital out the door, which leads to ultimately sometimes bad pricing decisions, which get to, believe it or not, negative IRR deals on the anchor builds. When we see that, we say the market is upside down. Building something with the notion to a -3 or a -4 IRR does not make sense. Second, too much leverage. The banks continue to fuel leverage. It's accessible. The bank market's never been more accessible. And, you know, I would offer to you that fiber is not as stable as ports or pipelines or toll roads. It's more complex. You sign one-year contracts, and you're only as good as the one-year contract that you deliver in enterprise fiber. It's not like traditional, you know, long-term hyperscale leases at 15 years or tower leases at 20 to 25 years. There is still day-to-day operational complexity in fiber. One of the things we see is exposure to poor credit quality counterparties. This is really interesting. What we see is the third or fourth carriers that are non-investment grade are packaging up their fiber assets and tower assets, selling them in joint ventures where the investor gets a 49% control, and you're seeing these deals get it done at 28 to 30 times. Makes absolutely no sense. Massive counterparty credit risk with a non-investment grade tenant, short-term leases, and a non-control investment. That is a recipe for value destruction. So risk premiums are rising and returns are falling at the same time. That is a reality if you're going to invest in this space. And then last but not least, finally, we've seen a shift in 2019. The total digital infrastructure spend is now favoring greenfield versus brownfield, which means all of the really good brownfield ideas have been mostly played out. And what you see is the opportunity now for greenfield CapEx versus brownfield CapEx. This will be in 2020, you'll see more greenfield CapEx than you'll see in M&A CapEx. Very interesting pivot there. And then last but not least, brownfield M&A is very expensive, right? So as we think about the total build cost per route mile, when we think about the total cost per tower, when we think about the total cost of delivering a data center per megawatt, M&A prices are 1.2 to 3x higher than replacement costs. If you were a real estate guy, you'd immediately say, I'm gonna go build, I'm not gonna buy. And until this gets back into equilibrium, where we've been focusing our energy is find good platforms at reasonable valuations and back the truck up into those management teams and continue to do greenfield until brownfield comes back to reality. So partnering has never been more important. As I've offered to you here, digital infrastructure is far more complex. You've got to have that 5.9 standards. We are very focused this year on risk. Risk is the #1 theme at Colony Capital this year as we think about investing our balance sheet. And as we finish deploying Fund 1, we're constantly thinking about how do we de-risk our portfolio and how do we protect our investors. We see the opportunity in greenfield. Greenfield, by the way, is a very difficult business. It's a difficult proposition. You can't just be an infrastructure GP and say, hey, I'm going to go build a web scale route from Columbus to Ashburn for Google. You can't do that. You have to be validated. Validation takes decades of operational expertise and validation by your customer. We're going to stay on our street corner. We know where our knitting is. Stay disciplined, focus on risk, focus on our customers. As we said at the beginning, where we think we can differentiate ourselves is be a trusted partner and landlord to the world's most important logos. Follow the customer, follow the logos. And last but not least, our 3 Ps remain intact. It's about the people, it's about having valuable products, and it's about the process. Execution is the #1 thing that our customers think about today. Thank you for your time, and with that, Dan Caruso, everybody.
So I was out to dinner a couple nights ago with Kevin O'Hara, and he reminded me that when I came up here last year, I opened the speech by saying, this very well might be my last keynote speech at Metro Connect, because as you know, there were a lot of rumors in the air last year. So this time I just want to emphasize, and this time I'm serious, this also might be my last keynote speech at Metro Connect. And because of that, I'm going to tell you a story, and it's called the Zales story. And the Zales story started in a blue-collar neighborhood just south of Chicago. This is the home I grew up in. And my dad worked for Western Electric. He commuted from Glenwood, an hour commute up to Lisle, Illinois. And they all dressed like that back then when they went to the phone company. And back then, there was just one phone company. It was called Ma Bell. It was AT&T. That's all there was. But then started to loom on the horizon long-distance companies, MCI, Sprint. And it was at that time that I was graduating from high school. I went to University of Illinois, got a degree in engineering. And while I was in the University of Illinois, another judge kind of had his mark on our industry, Judge Green. He decided a case that resulted in the breakup of AT&T. This fine chairman of Continental Telecom said, it's the dumbest thing that's ever been done. Yet, they were thinking ahead. They actually imagined that we would convey both voice and data on the same lines, doing things like electronic mail and video images. I don't know what a video image is, sounds like a picture to me, but all at the same time. It would even tell you who's calling you before you picked up the phone. Okay, that was the vision of the future. And with that, the baby Bells were born. 7 of them. And one of them became my first employer, post-college. I was actually Ameritech by that time, but it still went by the Illinois Bell logo, It was a garage in Naperville where they did splicing and installation, and I was part of a management program, so I managed a crew of about 5 or 6 union workers who didn't really like the fact that some college kid was all of a sudden their boss. So I learned some hard lessons there about what to do in that situation. While I was in that management development program, I went to University of Chicago and got my MBA at night. And during that period of time, this thing called fiber optics started to take root. Fiber optics both in long-distance context as well as the beginning of fiber in competitive metro situations. And there was this company in the suburbs of Chicago. They were headquartered in Omaha, but they were in Chicago suburbs, who was creating a lot of noise in the system. And a person that we're still fond of to this day, Royce Holland, used to be kind of the spokesman for the competitive dynamic in the industry. This was one of many of his fun quotes. He would just go out there and say publicly things like, Southwestern Bell is beyond a doubt the dinosaur in the industry. He was shaking things up. And I took notice. As I was trying to defend the Ameritech monopoly, I started to figure out I'd much rather be on the attack side. I'd rather destroy the monopoly than help protect it. And with that, I came across Kevin O'Hara, who's up here, Jim Crow, Royce Holland, and I joined Metropolitan Fiber Systems in Chicago. So MFS, it was originally called Chicago Fiber Optics, then Metropolitan Fiber Systems, and then eventually MFS Communications. And that's when this whole golden age of competitive access providers really started to take off. Names like TCG, Time Warner Telecom, Nextlink, and MFN, Metropolitan Fiber Networks. And that's when I came across Andy Littman. Andy and I crossed paths in about 93 or so, and Andy was driving a change that became the Telecom Act of 1996. And I got brought into that effort. I formed a group that we called the Co-Carrier Team. John Scarano was part of that group, who's in the room. And we used Andy's knowledge and his regulatory muscle to create kind of the business commercial framework around how do you compete with the Bell companies for the much broader range of telecom services, which began my love-hate relationship with voice and regulation. Okay, so we spent years on all this silly regulatory stuff, things like unbundled loops and what's a CLEC and co-carrier and DIDs and recip comp, and I learned over the course of a number of years that, man, that is a tough way to make a living. You looks really good for a while, then the floor gets pulled out from under you, the rug gets pulled out from under you, and you'll see that when we developed the plan for Zayo, part of the design was don't get caught up in a regulatory arbitrage situation. But there was this other thing happening about the same time. It was called the internet. So a series of steps from 93, 83, 1990, most of which wasn't on the radar, I suspect, of almost anyone in this room. It was happening, but we were unaware of it. Jack Waters, I think, is in the room. Jack Waters was, because his first job out of college was working for one of the very initial internet backbones. And he worked actually for this guy on this page. He worked directly for Vint Cerf, who is considered the father of the internet. And that's when you had the emergence of these internet backbone providers, UUNet, PSINet, ANS, BBN. Okay, it was this whole other thing that was emerging that we were having trouble getting our heads around, but we kind of knew it was a big deal. And one of the most important days of my early career was when Jim Crow brought us together in Lisle, in this big green building that still exists today, and he sat down in front of us with a screen and logged onto a computer that then played on the screen, which we all do every day in today's world. But back then, I've never seen anyone do that, especially not a CEO of a company. So he logs on and he starts pulling up early web platforms. Maybe it was, gosh, I don't know what it was back then. Maybe it was, the early search engines, the early email platforms. He takes us through this tutorial, and then he challenges us. He told everyone in that room, you got two choices. One is to embrace the internet, in which case you're going to be part of transforming MFS into a company that gets in front of the internet. Your other choice is to don't embrace the internet, in which case I ask only one thing: you move on, because this company is going to embrace the internet. So we did. And with that, MFS bought Uninet for what was at the time a staggering value of $2 billion. That's when we came across guys like John Sidgmore and Rick Adams. John ended up being my boss for a couple years. Fortunately, John died at a young age, but they had this thing going that was growing like crazy. And with that, a lot of it used our fiber networks. So we'd be building these fiber networks, these modem banks that would take all of the inbound calls from AOL and others and convert them into the telephone system, get paid recip comp, and it was just a crazy time. In fact, ironically, the project that we were implementing was called Project Dial Access Network, and they abbreviated it DAN, so it was Project Dan, which everyone thought was named after me, but it existed before I ever met these guys. But we still run into people to this day and say, you remember Project Dan? Remember we were doing all that? Because it was a wild time. But then Jim, shortly thereafter, I think even before the deal closed, he decided to sell Zayo. And this is an actual headline in Wall Street Journal. He decided to sell the company within an hour, which was not in my memory bank, so it was fun to reread the article. And in the article, it talked about he had plans to stay on as CEO of MFS and WorldCom's new chairman. He said he already got his 10 hours in the spotlight, and he doesn't have a need to seek publicity, and he doesn't see any personality clash with Bernie Ebbers. So the article went on to say the question may be how long the man who built MFS will stick around. Okay, the answer was not very long. So Bernie Ebbers, who also passed away, he spent his last years in jail, as I think most people here know. We'll get into a little bit of that later in the presentation. Passed away after being very sick just a couple months ago. But at this point, he was the pinnacle of the industry. He was the consolidator. He was pulling everything together, and MFS was one of his big conquests, but he went on and bought more after that. And with that, the team that was MFS, including Kevin, including Jim, and fortunately, including me, extracting myself out of WorldCom, I was one of the unlucky few that Bernie and company wanted to stick around, so I had to leave my equity behind, invested, and chose to join up with Kevin and others at what became Level 3. So this is a picture of the headquarters. When we first went out there and were scouting where to be, this was just one big open piece of land, and with the vision that we could establish our headquarters, have the front raised behind us, and use it to attract the kind of internet talent that we would need in order to be successful in building a company for the ages. But we weren't the only ones with big visions in those days. There were others as well. In fact, the article that announced what we were doing went on to say the proliferation of new fiber optic systems by Qwest, Broadwing, Williams, and now Level 3 raises a question, not unlike the one Marc just raised, is there too much capacity being built? So names like David Huber, Joe Nacho, Howard Jansen, and Gary Winnick, all were building and participating in this new boom of intercity fiber. And it was glory times. This is USA Today money. You see Jim on the bottom right corner, along with Walter Scott, who was the person who bankrolled both MFS and Level 3, alongside Bill Gates and Warren Buffett, with our original logo at Level 3, which is an L and a 3. Later we found out there was already a company that was L3, so we had to change our name to Level 3. But this also had an interesting kind of verbiage in the article. It said, Level 3, a dream team with a dream network and a killer business plan. Just don't screw it up. Okay. And with that became the long-haul fiber giants. Level 3, Qwest, Williams, Broadwing, Global Crossing. So whole another wave of kind of these infrastructure companies with visions of serving the booming bandwidth market. And it was a party. So this was 1999, and it was crazy. I mean, it really was. The times, for those of you who were in the industry, think of that .com boom, the telecom boom, all the craziness that was going on. And it looked like there was no end in sight. Things like appearing on Business Week and being called a telecom cowboy, as Bernie Ebbers was or one of my favorites that I dug up was in the New York Observer. This is the guy who was CEO of ICG, and the article goes on to say, he's tall, smooth, and charming, not unlike Marc and me, seductive, even. And the Vogue editor left her husband to be with Brian. That's how hot fiber optics was back then. And even President Clinton schmoozed with the Democrats in his Upper East Side salon. But then, fast forward a couple years, and the fiber optic fantasy slips away. The dream of striking it rich captivated one company after another, but rarely have so many people with so much money got it so wrong. Pretty sobering. And with that became a really tough time that led to a lot of our counterparts ending up in jail. There were probably at least 10 real examples of people who were running these companies who spent a number of years in jail for doing things that you just shouldn't do. And it was a nuclear winter for our industry. There were 4 years there that all hell broke loose, and things took a long time. In fact, the chart that you saw, Marc, you noticed that there was a period of time where there was almost no fiber being built, and it coincided exactly with these years. But during that time, I came across a couple guys. I had just left Level 3, trying to figure out what to do next, and I was introduced to Columbia Capital and MC Ventures. Unfortunately, Peter Claudy passed away shortly after we did this deal, but John Siegel, Jim Fleming, Peter Claudy, and Gillis Cashman, who I'll get back to in a second, we partnered together to buy ICG, that same company we just talked about. And it was a public company. We took it private. We paid 75 cents a share. None of that was, helped us do anything with the company. But the total amount that we invested in it was $8.7 million. And 8.7, 5 of that went to buy out the company. 3 went to consultants and attorneys and workout situations. So we basically put no money in the company itself. And this was a company that was burning cash like crazy. They thought they had 2 months left of cash on their balance sheet, and they weren't really sure what to do, and that's when we bought the company. Now, how John was able to say with a straight face he was pleased to be involved in one of the pioneer companies of competitive telecom, knowing the disaster that it was, I'm not sure how he got away with that quote. But it was very successful. Within 2 years, we took that $8.7 million and turned that into $250 million. The biggest piece of that being the sale of kind of the core property, the most important part of the property, to Level 3 for $163 million. But the rest of it was just picking up pieces and figuring out what to do with them. Found some land to sell within the company. We found subscale parts of the business that we'd combined with, in one case it was Empower, who was a public company, so we took some of their shares that turned out to be worth some good money. We just did a bunch of things. John in the room was a big part of all that fun. In fact, the inspiration for Zayo, this is where it came from. Okay, so the inspiration came from this experience of having a firsthand view of what was really going on in all this noise. When we first got involved with it, the floor was still bottoming out. Things were dropping real quick, revenue was declining, and seemingly with no end in sight. But as we started to hold this and do what we were doing, we started to see a stabilization process, where now all of a sudden, growth was, although negative, it was fairly flat. And then in the last couple quarters we owned it, we started to see growth. We did it by focusing on the right things, shutting down the wrong things, but we also were observing this wasn't just what we were going through at ICG, there was something going on in the industry that was transitioning from that correction cycle into new opportunities going forward. One other thing happened there as well. When I was in the closing process with Level 3, I had surgery. This isn't exactly my body, if you could tell by the Photoshop, but I had surgery on my hips and was recovering and spent the better part of 2.5 months sitting on a chair in the back of my house in a beautiful summer, and all of my team would come by and visit, usually one at a time, and we'd talk about, okay, what are we going to do next? And I had a bunch of free time on my hands, so I would just search company after company after company. What happened to this fiber company? What happened to that fiber company? And then I just started calling up whoever was running those companies, and I was hearing a lot of the same themes. Observed bandwidth wasn't going to go away. That was a trend that was going to continue, that fiber was going to be essential, that there will be consolidation in the space, and as consolidation happens, supply and demand will be balanced. And we had all these what I called fiber orphans, so these fiber companies that got moved aside, and then they were in the hands of accidental owners. And lastly, and very importantly, investors wanted nothing to do with it. They had lost so much money during the meltdown that they had a hangover, and we could take advantage of that. And with that became Zayo. Sandy Mays, John Scarano, Matt Erickson, part of my team, and Gilles Cashman and John Siegel, kind of leading it from an investor standpoint. We partnered together, and we made some really good things happen. The initial quotes are quite funny here. When I look back on them from the Denver Business Journal, multiple outcomes are possible, going public offering, gobbling up other companies as alternatives to selling the business. And with that, Zayo was born. This is our first office for those of you who go to Boulder each year for Colby's conference. This is nearby where that conference is. It was our first office, right behind Nick and Willie's. And we were called, not Zayo at the time, we were called Communication Infrastructure Investments. That was before people referred to communication infrastructure as a segment. Years later, we went public. And this is kind of a fun slide because this is our 2-week roadshow. Things looked pretty good when we were making our go, no-go decision, only to fall completely down every day of a 2-week roadshow to a point where when we finally priced, the morning of pricing, the headline was Oil, Europe, Ebola, spooks the markets. This is what we're waking up to, trying to decide whether we're going to be able to do our IPO. But we did. We went through the IPO. This is a lot of the original team of Zayo. Cindy's in this as well, my wife and a couple of my kids. It was a big day in the life of our company. As we reflect back on the journey with Zayo, we invested about $1 billion in the equity. And that equity today, as it's being transitioned to a private company, is worth $8.5 billion. So from an investor standpoint, it was certainly a positive outcome. But we also established this global brand, a unique brand, a durable brand with, I think, a pretty cool new logo and a nice tagline that says, "Our fiber fuels global innovation." We're the only infrastructure company today, I could have never imagined this to be the case, with substantial fiber in US, Canada, and Europe who's focused on communication infrastructure. Lots of fiber miles, route miles, buildings, et cetera. What we're really known for is the depth and breadth of our fiber networks, not just within the city centers, but in the regions surrounding them. And we have a good story for both our customers and our employees. These are our NPS scores. We hit the fourth quarter with an NPS approaching 50, which is outstanding by any industry. But in our industry, for a bigger company, this is probably unprecedented. And our employee engagement scores have also been progressing upward the right direction, hitting close to 80% as of the end of last quarter. And lastly, I want to talk a little bit about the role Metro Connect played in the progression of Zayo. A lot coincided with Zayo. When we first came to Metro Connect, when Zayo was starting, there was probably, I don't know, like 30, 40 people who would show up in the lobby, and we'd exchange ideas, and it's now grown to the size it is today. And we exchanged a lot of ideas with fiber rates, with our other counterparties in the industry, some of which I think are in the room today, some of which unfortunately passed on, like John Purcell. These are people who we would sit down and talk to and compare ideas, collaborate, think about what is really going on, trying to make sense of things. A lot of fun conversations in the lobby here, in the after hours, et cetera. There are also some hot tickets. The hot ticket to Colby's dinner and Zayo after-hour parties. They start out small. We had an after-hours, very select event. First one, there was probably 20 or 30 people who came to the event. It's since, we're not doing it this year, but it since grew to a big event. And Colby kind of started to coordinate his dinner to be at the same venue so we could flow right out of it. And that still is a very hot ticket, and I can't wait for the discussion tonight. Then there's the keynote speeches that I've been giving, and with them were some fun themes. I'll run through them real quick. Dark fiber and towers, Batman versus Superman. That was a fun one. Demand width, what's driving the appetite for connectivity. did that a few years ago. The scope and scale paradox of telecom. Why is it that companies that should have a ton of advantages because they have scale and scope, why is it they get beat by more focused companies who have a much more narrow scope and seemingly have disadvantages of not having either scale or scope, yet they do better for their investors? So what is it that causes that to happen, and how, as Zayo was getting more complex, how do we stay in front of that? There was a getting it right kind of reflection piece on how do you really create equity value. All the experience I went through, and a lot of us went through, where we've seen a lot of activity that resulted in very little equity value creation. What do we need to do to not just have a successful business in eyes of activity, but a successful business in eyes of the outcome for the investors? And then during the 2018 one, Reflections of an Anxious Chairman, there was a lot going on in the industry, so I was sharing kind of what we were going through to some degree. And then there was last year, Fleetwood Mac rumors. There were a lot of rumors going around this time last year, and couldn't really talk about them, but acknowledged them during the presentation. And then I used iconic characters along the way to help tell the stories. What's the one thing that matters, whether or not you're creating equity value. That's not to say that's more important than customers or employees or culture. It's to say that that's kind of your right to continue to move forward. If you're not creating value, you're not doing justice for your employees because it's a temporary situation. You're not really serving your customers because at some point in time there's going to be a reckoning that comes into play. So you got to get the equity value creation story right. Used a lot of Warren Buffett analogies. He's got words of wisdom, and use them to kind of tell the stories of the industry. A little bit of Mad Max here, telling us, telling the story of how he would view Zayo, perhaps, if he was reflecting on it. And then even one of our own here, Nick, as he was used to help tell the story about why he believed that towers were so much more superior than fiber. And I will say, if the vote was taken right now, he'd probably have to claim victory. But if they take a vote again in 20 years, or 10 years from now, we'll see. And then lastly, I want to talk about two of the most important deals in Zayo's history really have their roots here at MetroConnect, okay, literally. First one was with Bill LaPerche, who was on the prior slide as being one of the industry counterparts. We met here at the tail end of MetroConnect, out by the pool, and that's when we originally presented him in writing the offer to buy his company, and within a month and a half, we signed the deal. And then last year, if you read the prospectus, which is public, it was actually here at MetroConnect that I separately got together with Jan, who I didn't see in the room, although he should be here, and Marc, and we talked about there's an opportunity here for you guys. If you get organized, we could work together and find a way to get this done. I remember Marc texting me about 4 or 5 hours later after he caught up with Jan and said, Dan, I think we're going to get this done. And from there, it was probably 2 months later that the deal got signed. So this was the industry back then. And this is the industry today. Very, very different. Now, there's still a lot of smaller kind of opportunities going on. Maybe there's new things sprouting up. Maybe there'll be another wave. But one of the most important parts of our opportunity to create value going forward is that the industry structure is much more rational today. There's a much better balance of those who are suppliers with those who have demand. The consolidation is going to help us all. The future of Zayo, I got Jan on my left here, Marc on the right, partnership going forward, and we'll see where it goes from here.
Colby.
Shocking. I guess this one's for Marc. So as a portfolio company, in terms of all the different companies you have, are you able to increase the value of each one of them as being part of a broader portfolio? And I'm thinking of the recent deal you just announced between Zayo and DataBank and what you're doing there, and just trying to talk about the differentiation you have as having all these assets together. And then I guess just more bluntly, do you think that we've seen peak valuations across the space, whether you want to talk about it broadly for communications infrastructure by each of the different segments, just your thoughts on where we are in that trajectory.
Sure. Let me take the second question first, because I think it's easier, and then I'll answer the first one. I think valuations are at a crescendo. I don't think that valuations this year in particular, Colby, will subside. I think it'll be fairly stable because there's a lot of pipeline coming, and there's still a lot of liquidity sitting on the sidelines that needs to be put to work. And what we see is private market trades happening 4 to 6 turns wide of where public multiples are. And I don't see that phenomenon going away anytime soon, provided liquidity stays in the system. The coordination between the Chinese central bank, the European central bank, and the Fed is probably at its most cooperative phase I think we've ever seen in the history of capital markets. And that is so important because rarely have you seen those 3 institutions so synchronized around setting rates. And provided those 3 institutions stay in sync and continue to print money, you're not going to see a demonstrative change in interest rates. And provided interest rates are low and there's a lot of liquidity in the system, the abundance of liquidity happens in the private capital markets, which is infrastructure funds. And then provided that the central banks remain synchronized, you see the total cost of borrowing staying stabilized. And so the band plays on, I think is the adage for 2020. And if the band plays on, then valuations will probably either be stable or you could even see maybe valuations go a little higher. Where do we see the fractures in the cycle? Where we always look to in the fracture in the cycle is you look at secondary debt trading levels. And I don't know how many of you look at where the secondary market trades on term loan Bs and term loan As. If you don't, go find a coverage banker and get those updates every week. And those things begin to tell you there are certain stress points in the system. The stress points are really those second liens that got done 3 to 5 years ago that are now trading somewhere in the 60-cent range. And I would offer to you that some of those digital infrastructure stories that took on second liens are not as stable and are not as strong as other peers, which brings us to not all fiber networks are the same, not all tower companies are the same, and certainly that fracture, we're seeing that in the data center space where you see legacy telco assets that were bought by infrastructure funds, their second liens are now trading somewhere in the 60s and 70s. So there are hairline fractures in the credit cycle, but there are also really good stories and there's great logos. And I think you'll see that investors will fly to quality, and as long as liquidity stays in the system, I think probably valuations remain safe for this year. Second question as to where we think the ecosystem of Colony's business goes. We do have some flexibility, Colby, that I think is pretty unique, where we're not pigeonholed into one swim lane. And I think I showed you that slide earlier where we actually occupy multiple verticals in the digital infrastructure space. And so there will be situations where we can show up to a meeting with a customer and we can bring 2 or 3 different CEOs to the table and say, we'd like to provide a holistic solution for you. We would like to be a turfing solution to carrier Y. And we can do that. We can show up with someone that's a specialist in towers, small cells, fiber, and we can deliver the promise of an integrated network approach. At the same time, there's certain conversations that are very specific to a specific logo where that particular portfolio company has to show up and has an opportunity to very surgically price and deliver for a customer. So I think what gives us the flexibility is the ability to deliver a converged solution, but at the same time, we allow our portfolio companies to operate autonomously and work for the benefit of those shareholders that sit in those businesses. It's a fairly unique architecture. I don't think there's another architecture out there like it. But what it leads to ultimately is where I think alchemy for us is when CEOs, really smart CEOs like Dan and Raul get together and they work around this notion of edge computing and we bring and enable DataBank's edge data computing, all of the edge computing that Raul is doing is being enabled by Zayo's fiber. For me, that's nirvana. That means we've done something correct because really both of those companies benefit. And in turn, their customers benefit because we're delivering a faster and a better solution. So that's kind of the playbook, and that's where we're headed. And for right now, it seems to be working really well. The collaboration amongst our CEOs is fantastic, and it's a great fraternity of entrepreneurs and business leaders.
Oh, sorry.
We have a mic.
views on the recent announcement, Sprint, T-Mobile, and the effect on Dish as well, and how you see that affecting the overall industry, short-term and long-term.
No, go ahead.
Got 4 minutes, that's all for that.
4 minutes. I think most of us have priced in both scenarios. I think we both have thought a lot about the two different roads. You know, the reality is we're running neutral host infrastructure. So we have that benefit of being able to plan for both scenarios. I think this is the preferred, you know, from my perspective, this was always the preferred scenario. I was early supporting this transaction because I do believe that ultimately a stronger T-Mobile can ultimately put more capital to work and fuel innovation and competition, which I think is healthy. And I think also the opportunity for Charlie is significant because he can really be one of the early adopters and enablers of the promise of 5G. He's already begun building, as you know, an IoT network. And I think having a fourth carrier that's focused more on IoT, on machine-to-machine connections, is a very interesting paradigm. And so the outcome of this is it should be good for consumers. It should be good for innovation. And this is maybe one of those instances where the regulators got it right. Ultimately, we're going to have two very important customers for Zayo that Dan already has extensive relationships with. And I'm excited. I think this is the right outcome. And certainly, I think for everyone in this room, it's the right outcome.
So Dan, looks like a question came in from one of the ICG founders.
I think this is a good one for Marc to answer. Being that you are from Chicago, why didn't you use John Belushi as one of your slides? Just saying. Good point. I will incorporate John in, one of my all-time favorites, and you know, I still reflect back on the short life that John lived and what could have been if he lived a longer life. He entertained us so much in that short period of time that we all knew him and loved him.
And it wasn't over when the Germans bombed Pearl Harbor.
No, it wasn't.
Just remember that.
Okay, we have a few more minutes left. Don't let this opportunity go to waste. You can always drink more coffee.
Marc, you mentioned the Telefonica AT&T transaction where they're going to, share their radio access network, which is some version of network slicing. If you could give some insight on how you think that plays out for, both fiber and tower companies.
Yeah. So the questions around the recent announcement of Telefonica moving their capacity onto AT&T's network. This is inevitable, I think is the adage. And I think if folks are investing in digital infrastructure, they need to be thinking carefully around this notion of counterparty credit risk. And, Telefonica is a huge customer of ours in Mexico, and the implications of that are that ultimately they're going to be terminating leases on our portfolio, which in one instance is obviously not good. That's a degradation in cash flows. And by the way, anyone that owns infrastructure in Mexico is facing the same issue. The question is, how do you respond? And the ultimate answer is you focus more on the customers that are going to continue to grow. We believe AT&T is going to need more infrastructure in Mexico. We believe that Altán will shoulder a lot of the burden in terms of providing that rural and suburban and corridor traffic for ultimately AT&T, which will host Telefónica's network. So we've spent a lot of time working with Altán. We've been at the early formative phase of their network in phase 1 and phase 2. But it is a cautionary tale. I think emerging markets are hard. They're not easy. I think American Tower got that lesson taught to them pretty well in India. And when you go into emerging markets, you always have one logo that's the predator. In Mexico, that predator happens to be our friend and our customer. We don't view it as a predator. And so you have to very carefully look at each of the credits that you're going into, whether it's fiber, whether it's towers, really understand who your counterparty credit risk is. Because Telefónica's gone through the region, they've sold all their infrastructure for multiples that are well north of 20. And for the folks that have bought their fiber and their towers, the value proposition, at least in Mexico, is you got 5 to 6 years of cash flows. Telefonica got the better of that trade. If you're a tower co or you're a fiber infrastructure player, you have to think carefully about your master lease terms. And so as we look across Latin America and we see the competitive landscape, and I'm picking on the tower industry, it's probably not fair, but we see some of these deals that are getting done now. You look, for example, it was a very small print. You look at the Entel American Tower transaction that just got done in Peru and Chile. That multiple was close to 24 to 26 times, a massive multiple. And so what are you getting in return? Well, you're getting a long-term relationship with Intel. Have you given up RAN sharing? Have you given up that network sharing piece that where Telefónica's come together with AT&T? And you have to start thinking about that. I think counterparty credit risk is probably the #1 thing that we talk about in investment committee today. And then you got to think about technological obsolescence. You know, where does the macro site fit in 5G? Is ultimately the macro site just a series of antennas and a remote radio unit up top with a tower-mounted amplifier, and at the bottom you no longer have the BTU cabinet because you're front hauling that capacity back to a baseband hotel or a CRAN hub? You really have to be careful. This is maybe the most perilous moment in time in investing in digital infrastructure because the multiples are so absolutely high, and what you're getting back in terms of the paper isn't that good. Look at what happened last year in Europe in terms of the sale leasebacks with Altice. The people that bought into that transaction didn't even get a lease. They got a master services agreement and paid over 20 times for that asset. So if that thing goes into bankruptcy, you're completely naked and exposed. And your counterparty credit risk is someone who's not investment grade. A great operator, a shrewd operator, but it's all about measuring risk. This is what we're going to be talking about for the next couple of years because technology is changing so rapidly, the needs of the carriers and the infrastructure is changing rapidly, and we're taking risk premiums that are far greater than we've ever seen in the industry. Sorry to be sort of the cold shower, but this is the stuff that we're thinking about.
I have
So let me
One
take
question.
the second question first, if I could. So Zayo and Extenet are each independently building small cells. When did you join forces and take on a bigger role in the market? Dan, you want to start with that?
Well, there's been a history between Zayo and Extenet that dates back many years. We've done a lot in San Francisco together. So much predated kind of Zayo's acquisition of ELI. So we do look for ways to collaborate in different markets, but we also at times compete. Sometimes there's markets that we have a much deeper presence in, a market where we've done a lot of mobile infrastructure, and we've done a fair amount of small cells that you then get to add on business. Other times there's opportunities to take a market and work together on it.
Yeah, I think it's been the moments of collaboration between the two organizations. We were actually talking about it earlier today. San Francisco, for us, is probably our highest IRR network across the entire Extenet ecosystem, and that was largely because Extenet and Dan worked together to build that network. And so the future has to be more of that. I think for both organizations, for Zayo to continue to grow in where it excels, which is broadband infrastructure, and where Extenet excels, which is the vertical real estate and the RF design work and the pole and node implementation. The hope is that both those organizations can, to Colby's point earlier, where we can collaborate and actually deliver outsized returns to the benefit of both organizations. And there's no better place to do that than Extenet and Zayo.
Great. Let me go hear our last question.
There's been a lot of press coverage recently on the mega constellation of satellite operators, and some of the big, most wealthiest people in the world are putting a lot of capital, some of their own capital there. I wonder, could you talk to that as a threat, perhaps, or as an opportunity? What do you see for the telecom industry?
Yeah, for years and years and years and years, the question of isn't wireless going to get to a point where it makes fiber obsolete? I remember having a conversation only about 4 or 5 years ago in San Francisco with SoftBank, and where Masa was explaining to me how backhauling small cells with wireless is going to be a thing that they do, and it's going to create a competitive advantage. It's because there's no fiber out there, and or fiber is just too expensive to do that. I don't hear anyone talk about that stuff today. No one. Everyone views it as, from practical experience, that the more wireless becomes important, the more dense fiber needs to be. Fiber kind of feeds those radios. It feeds them not just to small cell sites, but it feeds it into buildings. So as the next generation of in-building kind of radios get developed, those radios, CBRS, connect to fiber. As Marc pointed out earlier, it's not just one fiber strand. It's fiber strands that act as the connectivity between radios and the core of the network. Bandwidth is going to grow. If we think we've seen bandwidth growth, historically, bandwidth growth in the future is going to eclipse that for all the obvious reasons, all the developments that are taking place. The thought that we're going to have satellites up in the air that are going to somehow make the need for fiber less relevant is just so unlikely to be true. In fact, I don't even hear anyone speculate to that degree. I hope some of these satellite ideas work. Certainly a lot of money is going to pour into that, but I don't think in a way that's going to, any time in our grandchildren's lifetime, threaten the importance of fiber.
Great, means we'll have at least a Metro Connect 2021. Okay, please join me. Big round of applause for Marc and Dan.
Thank you.